The biggest investment mistake, never starting at all. Here's the most brutal truth about investing. The biggest mistake you can make in 2025 is to sit on the sidelines and do nothing. Some people are so scared of investing that they never even begin and lose out on the amazing compounding effect that can happen over the long term, says financial expert Danielle Harrison. This isn't just about missing out on gains, it's about watching inflation systematically destroy your purchasing power while you do nothing. Keeping all your cash in a bank account means that money loses its purchasing power due to the rising rate of inflation. While you're sitting on the sidelines, waiting for the right time, every day you delay is compound interest working against you instead of for you. Let me put this in perspective. If you had invested $10,000 in the S&P 500 at the beginning of 2020, even through a global pandemic, market crashes, and economic uncertainty, you'd have over $18,000 today. Meanwhile, that same $10,000 sitting in a savings account would be worth about $8,500 in purchasing power due to inflation. The investment landscape heading into 2025 appears poised for strong growth once again. After numerous turbulent years, led by pandemic-era retractions and then challenges in the tech sector, 2023 and 2024 saw quality growth overall. But here's the kicker. Every day you wait is another day you're not building wealth. People who never invest often rationalize their decision by saying, "I don't know enough," or "I'll start when I have more money." But here's the reality. You don't need to be Warren Buffett to start investing. And you don't need thousands of dollars. You can start with $100 and learn as you go. The biggest risk isn't losing money in the market, it's guaranteeing you'll lose purchasing power by doing nothing. FOMO, investing. Chasing yesterday's winners. Moving from those who never invest to those who invest for all the wrong reasons, let's talk about FOMO investing. Whether it be participating in a frenzy over GameStop stock, which we all saw back in 2021, or investing in the newest cryptocurrency, chasing the trends is a common mistake investors make. The GameStop saga serves as a ready-made case study, highlighting the dangers of FOMO investing. While some individuals may have experienced fleeting gains by buying and selling during the Reddit-fueled surge, many others faced substantial losses when the bubble eventually burst. Let's check in on a few popular meme stocks from 2021 and see how they're doing. AMC Movie Theaters stock is down 98% from its 2021 meme stock bubble peak. GameStop stock is down 82% from its 2021 peak, and Bed Bath & Beyond was a popular meme stock for a while in 2021, but it went bankrupt in 2023. A lot of investors make the mistake of chasing trends or what's cool because of FOMO, says financial expert Douglas Boneparth. The problem is that by the time you hear about the hot investment on social media, the biggest gains have usually already happened. You're essentially buying high and hoping someone else will buy even higher. FOMO investing puts people into a bad headspace where they feel anxious and twitchy, like they absolutely must act now to invest in something, or else they're throwing away a fortune and ruining their lives. The volatility of meme stocks and cryptocurrencies and the speed at which their prices can change dramatically makes them even riskier than traditional investments because you could be distracted for less than 30 minutes and come back to see that your portfolio has cratered. The rise of social media has made this problem worse. We'd often prefer to lose money together, as it can sometimes soften the blow. Today, creating an investing account has never been easier, thanks to user-friendly apps like Robinhood and Revolut, which only makes it simpler for uninformed individuals to start taking investment recommendations from Twitter and TikTok, buying into companies they might never have heard of before. Emotional investing. Your feelings are not your friend. Building on the FOMO theme, emotional investing is perhaps the most expensive mistake you can make. Emotional reactions to market fluctuations or expecting but not receiving immediate results can lead to impulsive decisions. Your worst enemy when it comes to investing isn't the market, it's the person staring back at you in the mirror. I have told many clients to turn off their TVs and stop watching the daily market news, says Missouri-based CFP Danielle Harrison. While it's normal to keep an eye on what's happening in the overall economy, It's easy to get swept up in the excitement or doom and gloom of it all. The markets are constantly moving, and trying to follow along in real time can lead you to continuously checking or changing your investments when you're better off leaving them alone for the long haul. Here's the brutal math of emotional investing. When you panic and sell during market downturns, you're essentially buying high and selling low. The exact opposite of what you want to do. One mistake that novice investors often make involves behavior during a market correction, or worse, conditions that devolve into a bear market. When the market is trending sharply downward, people who haven't experienced substantial losses before might be tempted to sell their assets, taking whatever profits they can in the process. Since 1980, the S&P 500 index has experienced a decline of about -14% on average in any given calendar year. Yet stocks have normally recovered and finished with average gains of about 13% in any given calendar year, including dividends. So, a market decline of -10% or -15% isn't unusual, nor necessarily a sign that stocks will continue to decline. The problem is that since no one can predict the market accurately, you may be looking at a flash crash in which assets rebound rapidly, leaving you out of your positions and having to buy in at much higher prices. You're likely to perform worse than if you just stuck with your original strategy in the first place, trying to time the market, the impossible game. Speaking of market timing, this leads us to one of the most seductive and destructive investment mistakes: trying to time the market. Making the mistake of trying to time the market can lead to severe financial consequences, but more often than not, it will simply leave you missing out. Trying to time the market by buying low and selling high is notoriously difficult. If you frequently buy and sell based on short-term market volatility, you may incur higher transaction costs and can miss out on long-term gains. Taking a microscopic view of the marketplace and looking to execute specific trades on a specific timeline ensures that you miss the larger picture. Here's why market timing doesn't work. Even professional fund managers with teams of analysts, sophisticated computer models, and decades of experience struggle to consistently time the market. What makes you think you can do it better from your kitchen table while scrolling through financial Twitter? The data on this is devastating. According to multiple studies, the average investor significantly underperforms the market specifically because they try to time their entries and exits. When you invest is far less important than actually doing it. Some trades will be winners and others losers, but keeping money in the market is the best way to enjoy the profits of time and well-researched investments. It's time in the market that counts, not timing the market. The S&P 500 index has delivered average annual returns of 10.7% for the past 30 years. If you just keep building a diversified portfolio of stocks month after month with every paycheck, hopefully for many years, you're likely to save and invest enough money for a comfortable retirement. Instead of trying to time the market, use dollar-cost averaging. Invest the same amount of money at regular intervals regardless of market conditions. This way, you buy more shares when prices are low and fewer when they're high, naturally smoothing out your average cost. Putting all your eggs in one basket. While we're talking about fundamental mistakes, let's address one that can wipe out years of gains in a matter of days. Not diversifying your portfolio. Putting all your money into one type of investment or concentrating on one sector can be risky. Most financial advisors recommend breaking out and diversifying when it comes to a long-term investing approach. For 8 of the past 10 years, the majority of stocks in the Russell 1000 index have generated lower annual returns than the index itself, and an average of 37% of those companies have suffered negative returns each year. This is why putting all your money into individual stocks, even sure things, is so dangerous. Overconcentration can become a big issue even for portfolios that start off diversified. You might hold shares in a stock or sector that has grown appreciably, accounting for an increasingly large share of your portfolio. You might hold the same stock across different funds, particularly in cap-weighted funds that give extra weight to companies with the biggest market capitalizations. While diversification does not guarantee a profit or protection from a loss, it can help to spread your risk so that one set of poor-performing investments doesn't upend your whole plan. It's also wise to regularly rebalance your portfolio. Your investments can drift from your target allocations due to market fluctuations or changes in your timeline or goals. Think of diversification like this. If you own only tech stocks and the tech sector crashes, you're wiped out. But if you own tech stocks, healthcare stocks, international stocks, bonds, and REITs, a crash in one sector just creates a buying opportunity in the others. True diversification means spreading your investments across different asset classes, stocks, bonds, real estate, different sectors, technology, healthcare, finance, different geographies, US, international, emerging markets, and different company sizes, large cap, mid cap, small cap. Paying too much in fees, death by 1,000 cuts. One of the most insidious investment mistakes is paying excessive fees because it happens slowly and quietly while devastating your long-term returns. High fees and expenses can eat into investment returns over time. Be aware of the costs associated with your investments, including account management fees, trading commissions, and taxes. Here's the math that should terrify you. A 1% annual fee might not sound like much, but over 30 years, it can cost you hundreds of thousands of dollars in lost returns. If you invest $10,000 annually for 30 years with 7% average returns, you'd have about $944,000 with a 1% fee versus $1.22 million with a 0.1% fee. That seemingly small 0.9% difference costs you $276,000. This is why actively managed mutual funds with expense ratios of 1 to 2% are wealth destroyers for most investors. You're not just paying the fee, you're paying the fee plus losing all the compound growth that money would have generated over decades. The solution is simple. Stick to low-cost index funds and ETFs with expense ratios below 0.2%. Vanguard, Fidelity, and Schwab all offer excellent low-cost options that track the overall market. You'll likely outperform 80% of professional fund managers while paying a fraction of the fees. Pay attention to trading fees too. Some brokerages charge $4.95 or more per trade, which might not seem like much until you realize you're paying $10 round trip every time you buy and sell. If you're making regular investments, these fees add up quickly and eat into your returns. Investing money you can't afford to lose. Another critical mistake is investing money you need for short-term expenses or emergencies. People jumping into the markets before building themselves a strong financial foundation is the biggest mistake financial advisor Douglas Boneparth sees investors make. Prior to investing, you should feel in control of how you spend your money. A big part of that is building a cash reserve so you don't need to rely on your investments when you run into an emergency or want to make a certain purchase. The stock market can be volatile, and you'd hate to lose the money you were saving for something like a down payment on a home you were wanting to purchase, says financial expert Danielle Harrison. A big mistake many investors see is bailing out on an investment because they did not double their money in a certain period of time, which is usually days or weeks. If you need your money to grow urgently, you probably don't have proper savings, says financial expert Lauren Williams. Quick growth comes with a lot of risk. The rule is simple. Never invest money you'll need within the next 3 to 5 years. Emergency fund first, then investing. You should have 3 to 6 months of expenses saved in a high-yield savings account before you start putting money into the stock market. When you invest money you can't afford to lose, you're forced to make emotional decisions at the worst possible times. Market crashes become existential crises instead of buying opportunities. You end up selling at the bottom because you need the money, locking in losses instead of waiting for recovery. Chasing performance and hot tips. Like market timing mistakes, it can be tempting to chase recent top-performing investments or follow the crowd without conducting research. When you know the background or have someone with experience on your side, you can better recognize when assets seem overpriced and likely to end up being underwhelming because it's what everyone else is doing. This mistake often manifests as buying last year's top-performing fund or stock, assuming it will continue to outperform. But here's the reality. Past performance does not guarantee future results. In fact, studies show that yesterday's winners often become tomorrow's losers due to reversion to the mean. The financial media makes this worse by constantly highlighting the latest hot stock or fund manager who's crushing the market. What they don't tell you is that most of these hot investments had their run before you heard about them. By the time something becomes mainstream news, the smart money has often already moved on. A lot of investors make the mistake of chasing trends or what's cool because of FOMO, says Boneparth. He recommends always doing your due diligence before putting your money in the market. You'll be much more empowered if you know what you're putting your money into, understand the trends of those assets, and have a long-term plan that's built to withstand market movement. Social media has made this problem exponentially worse. We see finance influencers appearing out of nowhere, offering advice on which stock or crypto to buy. Naturally, humans have a tendency to follow the crowd in order not to fall behind. But taking investment advice from someone with a TikTok account and a Lambo is like taking medical advice from someone who stayed at a Holiday Inn Express. Not having a plan, flying blind with your money. Investing without a clear goal can lead to confusion and poor decision-making. Setting a clear investment goal helps you define your expectations, time horizon, and risk tolerance. It also helps you create a roadmap to achieve your financial objectives. Examples of unclear investment goals include investing without a specific time horizon or target, investing without a defined purpose, and investing without considering your risk tolerance. For instance, investing in stocks without understanding the risks involved, or investing in mutual funds without knowing the fund's investment objective. Without a plan, you're essentially driving cross-country without a map or GPS. You might eventually get somewhere, but it probably won't be where you wanted to go, and you'll waste a lot of time and money along the way. A proper investment plan should include your specific financial goals, retirement, house down payment, kids' education, your time horizon for each goal, your risk tolerance, your asset allocation strategy, and regular review and rebalancing schedule. Having a plan keeps you disciplined during market volatility. When the market crashes and everyone's panicking, your plan reminds you why you're investing and keeps you from making emotional decisions that will hurt your long-term returns. Ignoring taxes. Letting the IRS become your silent partner. One of the most overlooked investment mistakes is ignoring the tax implications of your investment decisions. High taxes can significantly erode your investment returns over time, yet many investors focus solely on pre-tax returns. The difference between investing in taxable accounts versus tax-advantaged accounts like 401ks and IRAs can be enormous over time. If you're not maxing out your 401k match, you're literally turning down free money. It's simple. If your employer contributes 50 cents for every dollar you save, that's an immediate 50% return. No other investment will give you that kind of guaranteed return. Tax loss harvesting is another strategy many investors miss. This involves selling losing investments to offset gains from winning investments, reducing your overall tax bill. But it requires careful planning and understanding of wash sale rules. Asset location is equally important. Holding tax-inefficient investments in tax-advantaged accounts and tax-efficient investments in taxable accounts. For example, REITs and bonds generate regular income that's taxed at ordinary income rates, so they're better held in IRAs. Growth stocks that you plan to hold long-term are better in taxable accounts where you can take advantage of lower capital gains rates. Not staying updated and educated. When you're on top of your investment's performance, economic trends, changes in tax laws, and market developments, you're in a better position to take advantage of opportunities. Regularly review your portfolio and financial goals, and consider consulting with a financial advisor if you need help staying in the know. The investment landscape is constantly evolving. New investment vehicles are created, tax laws change, and market conditions shift. Investors who don't stay educated often miss opportunities or continue using outdated strategies that no longer work. But here's the balance. You want to stay informed without becoming obsessed with daily market movements. Follow reputable financial news sources, read annual reports from your fund companies, and review your portfolio quarterly, not daily. Many investors make the mistake of either completely ignoring their investments after the initial purchase or obsessively checking them multiple times per day. Neither approach is optimal. You should be informed enough to make good decisions, but not so involved that you're tempted to constantly tinker with your portfolio. Conclusion: learning from expensive mistakes. The most damaging mistake you can make in your investment journey this year is actually a decision not to invest at all. But once you start investing, avoiding these common mistakes can be the difference between building wealth and staying poor. There's an endless assortment of ways to make mistakes that hurt your portfolio, though most fall into 4 broad categories: believing things that are not true, attempting to operate outside of your skill set, allowing your behavior to be driven by emotions, and failing to let time work for you. Remember that legendary investor Benjamin Graham said, "The investor's chief problem, even his worst enemy, is likely to be himself." Successful investing involves knowing yourself and your finances, having discipline, and staying updated on research and trends. The good news is that you don't have to be perfect to succeed at investing. You just need to avoid the major mistakes that derail most people. Start with a solid foundation, emergency fund, low-cost diversified investments, and a long-term plan. Then stay disciplined and let compound interest do the heavy lifting. Many of us may look back on previous investment decisions and realize that we weren't as correct as we might have liked to have been. Failure can be a difficult thing for investors to admit, but it's essential that you examine your failures as well as your successes. This will help you avoid making the same mistakes again in the future. The key takeaway is treating investing like a spin at a roulette wheel. By betting on highly speculative stocks is not a sustainable strategy to build wealth over the long term. The reality is that the odds are heavily stacked against those who attempt to time the market. Instead, focus on what you can control, keeping costs low, staying diversified, maintaining a long-term perspective, and avoiding emotional decisions. These might not be as exciting as trying to find the next GameStop, but they're the principles that actually build wealth over time. Mistakes are a part of investing, and successful investing only requires that you realize and learn from them. When it's done right, investing could help you build a more secure financial future. When it's done wrong, your risk of losing money increases, jeopardizing your long-term plans. The difference between investors who succeed and those who fail isn't intelligence or luck. It's discipline and the ability to learn from mistakes without repeating them. Start today, stay consistent, and let time work in your favor instead of against you.